Picture this, it's March 2020. The stock market is crashing. Headlines scream about the worst economic crisis since the Great Depression. Two investors sit watching their portfolios. The first investor panics. He sells everything, locking in massive losses. I need to protect what's left, he thinks. 6 months later, as markets recover, he's too scared to get back in. He misses the entire rebound. The second investor stays calm. She sees the crash as an opportunity. While others are selling in fear, she's buying quality companies at discount prices. 2 years later, her portfolio has not only recovered but reached new highs. What made the difference? The second investor understood something the first didn't: the principles of intelligent investing taught by Benjamin Graham. Benjamin Graham wasn't just any economist. He was the legendary father of value investing, the man who taught Warren Buffett everything he knows about making money in the stock market. When Buffett describes Graham as the most important influence on his investment philosophy, that's not casual praise. That's a testament to the power of Graham's ideas. In 1949, Graham published The Intelligent Investor, and more than 75 years later, it's still considered the Bible of investing. Warren Buffett calls it by far the best book on investing ever written. Think about that. In a world of constantly changing technology, social media, and financial innovation, why does a book from 1949 still matter? Because Graham understood something timeless: markets change, but human nature doesn't. The same emotional mistakes that destroyed investors in 1929 still destroy them today. The same disciplined principles that built wealth in Graham's era still build wealth now. The purpose of The Intelligent Investor isn't to teach you how to get rich quick, or time the market perfectly. It's something far more valuable: how to build lasting wealth through disciplined, rational, long-term investing. Not speculation. Not gambling. Over the next half hour, we will explore the core principles that have made ordinary people wealthy, and kept wealthy people from going broke. These aren't complex strategies requiring advanced degrees or insider knowledge. They're simple, powerful concepts that anyone can understand and apply. Are you ready to think like an intelligent investor? Let's begin. Part 1. The difference between investing and speculating. Before we dive into Graham's strategies, we need to understand a crucial distinction that most people get wrong: the difference between investing and speculating. Graham defines investing as purchasing assets based on thorough analysis, with the expectation of reasonable long-term returns, while preserving capital. Notice the key words: analysis, long-term, and preservation of capital. Speculating, on the other hand, is betting on price movements, without regard to the underlying value of what you're buying. It's essentially gambling, hoping prices will go up for reasons that have nothing to do with the actual worth of the asset. Here's the problem: many people think they're investing when they're actually speculating. They buy stocks because they heard a tip, read a headline, or saw the price going up. They have no idea what the company actually does, or whether it's worth what they paid. Consider this example. In 1999, during the dot-com boom, a company called Pets.com went public. The stock price soared on the first day. People bought it because the internet is the future, and e-commerce is going to be huge. They were speculating, betting on a story without analyzing the business. An intelligent investor would have asked different questions. How does Pets.com make money? What are their profit margins? How do they compete with established retailers? Can they actually deliver 50-pound bags of dog food profitably? The answers weren't pretty. Pets.com was losing money on every sale, burning through cash, and competing in a business where customer loyalty was low. The company went bankrupt within 2 years. Meanwhile, intelligent investors who bought shares in boring companies like Coca-Cola, Johnson & Johnson, or Procter & Gamble, companies with steady earnings, strong brands, and sustainable business models, saw their wealth grow steadily over decades. Graham's lesson is clear: identify whether you're investing or gambling. True investing requires analysis of the underlying business, not just the stock price. It means buying companies you understand, at prices that make sense, with the expectation that their earnings will grow over time. Speculation isn't necessarily wrong. Graham himself acknowledges that some speculation can be appropriate for a small portion of your portfolio. But call it what it is. Don't mistake gambling for investing, And don't risk money you can't afford to lose on speculative bets. The intelligent investor knows the difference and acts accordingly. This simple distinction, understanding what you're actually doing with your money, is the foundation of everything else we'll discuss. Part 2, The Intelligent Investor's Mindset. Here's a startling truth: intelligence, in the traditional sense, has very little to do with investment success. You don't need to be a genius to build wealth in the stock market. But you do need something much rarer: emotional discipline. Graham observed that the stock market is driven by human psychology, waves of fear, greed, and overconfidence that push prices far above or below what assets are actually worth. This creates opportunity for disciplined investors, and disaster for emotional ones. The greatest enemy of the intelligent investor isn't market crashes, economic recessions, or even bad companies. It's themselves. As Graham famously wrote, the investor's chief problem, and even his worst enemy, is likely to be himself. Think about the last time you made a financial decision based on emotion. Maybe you sold stocks during a market crash, because you couldn't stand watching the losses. Maybe you bought a hot stock because you felt like you were missing out. These decisions feel rational in the moment, but they're driven by fear and greed, not analysis. The intelligent investor develops a different mindset. They understand that market volatility is normal, even healthy. They don't check their portfolio every day or react to financial news headlines. They focus on the long-term value of their investments, not short-term price movements. Consider Warren Buffett's approach during the 2008 financial crisis. While banks were failing and the stock market was crashing, Buffett was buying. He invested $5 billion in Goldman Sachs, purchased shares in companies like Coca-Cola and American Express, and wrote an op-ed titled, "Buy American." Was Buffett smarter than everyone else? Not necessarily. But he had the emotional discipline to see opportunity where others saw disaster. He understood that great companies don't become worthless overnight, just because their stock prices fell. The intelligent investor's mindset has several key components. Patience. Wealth building takes time. There are no shortcuts. The magic of compound interest only works if you give it years or decades to operate. Rationality. Decisions should be based on facts and analysis, not emotions or hunches. If you can't explain why you're buying or selling something, you probably shouldn't. Humility. The market is unpredictable in the short term. Anyone who claims to know where it's going next is either lying or deluded. Focus on what you can control: your own behavior. Discipline. Stick to your investment plan even when it's uncomfortable. This means buying when others are selling and staying calm when others are panicking. Graham's insight was revolutionary. You don't need to be the smartest person in the room to succeed as an investor. You just need to be the most disciplined. This levels the playing field and gives ordinary people the tools to build extraordinary wealth. Part 3, Mr. Market, the parable. To help investors understand market behavior, Graham created one of the most powerful metaphors in all of investing: Mr. Market. Imagine you own a small business in partnership with a man named Mr. Market. Every single day, Mr. Market shows up at your door with an offer to either buy your share of the business or sell you his share. The price he quotes changes daily based on his mood. Some days, Mr. Market is wildly optimistic. He's convinced the business is worth a fortune and offers to buy your share for twice what you paid. Other days, he's deeply pessimistic. He's sure the business is worthless and offers to sell you his share for half of what it's actually worth. Here's the key: Mr. Market's daily price quotes have nothing to do with the actual value of the business. They're driven purely by his emotions, his fear, greed, optimism, and pessimism. You have 3 choices every day. 1. Sell to Mr. Market when his price is attractively high. 2. Buy from Mr. Market when his price is attractively low. 3. Ignore Mr. Market completely. The intelligent investor realizes that Mr. Market is there to serve you, not to guide you. His quotes are opportunities, not instructions. You should only trade with him when it's clearly to your advantage. Let's apply this to real investing. In March 2020, Mr. Market was offering to buy shares of Microsoft for $135. Just 1 month earlier, he was willing to pay $190 for the same shares. Did Microsoft suddenly become 30% less valuable as a company? Of course not. Their software was still dominant, their cloud business was still growing, and their financial position was still strong. The parable teaches us several crucial lessons. Stock prices fluctuate far more than actual business values. A company's earnings might grow 10% in a year, but its stock price might rise 50% or fall 30%. This disconnect creates opportunities. Market sentiment is often wrong. When everyone is optimistic, prices tend to be too high. When everyone is pessimistic, prices tend to be too low. The intelligent investor takes advantage of these extremes. You don't have to trade every day. Just because Mr. Market makes daily offers doesn't mean you need to accept them. Sometimes the best action is no action. Focus on intrinsic value. The daily price quotes matter less than the underlying value of what you own. If you own shares in a great company at a fair price, temporary price declines are just noise. Graham's Mr. Market parable has helped countless investors stay calm during market crashes and avoid getting caught up in bubbles. It's a reminder that markets are driven by human emotion, not perfect logic, and that creates opportunities for those disciplined enough to take advantage of them. Part 4. Margin of safety. Graham's core principle. If you take away only one concept from Graham's entire philosophy, let it be this: margin of safety. This principle isn't just central to intelligent investing, it's the foundation that makes everything else possible. Margin of safety is the difference between an asset's price and its intrinsic value. In simple terms, it means buying something for significantly less than what it's actually worth. This gap protects you against errors in analysis, unexpected problems, and market volatility. Think of it like buying a house. Imagine you find a property that independent appraisers value at $500,000. The owner is asking $450,000. That $50,000 difference is your margin of safety. Even if the appraisers were wrong by 10%, you would still be paying a fair price. If they were right, you have bought a valuable asset at a discount. Now imagine the same house being offered for $550,000. Even if the appraisers were exactly right about the $500,000 value, you would be overpaying. If they were wrong or if the market declined, you could lose substantial money. The same principle applies to stocks. Let's say you have analyzed a company and determined its intrinsic value is $100 per share. Graham would recommend buying only if you can get shares for $70 or less, a 30% margin of safety. This protects you in multiple ways: protection against analytical errors. Maybe you overestimated the company's future growth or underestimated its competitive challenges. The margin of safety gives you room to be wrong. Protection against market volatility. Even great companies see their stock prices fluctuate. If you buy at a discount, temporary price declines are less likely to cause permanent losses. Protection against unforeseen events. Companies face unexpected challenges, new competition, regulatory changes, economic downturns. The margin of safety provides a cushion against these surprises. Consider Warren Buffett's investment in Coca-Cola in the late 1980s. Many investors thought he was crazy for buying up a mature company when technology stocks were soaring. But Buffett saw a company with a powerful brand, growing international presence, and strong cash flows trading at a reasonable price. He bought with a margin of safety, and those shares became one of his most successful investments. The margin of safety principle forces you to focus on minimizing downside risk, rather than chasing maximum upside potential. This might seem conservative, but it's actually the key to long-term wealth building. As Graham noted, the essence of investment management is the management of risks, not the management of returns. This principle also provides psychological benefits. When you know you bought something at a substantial discount to its true value, it's easier to stay calm during market volatility. You're not worried about every price fluctuation, because you know you bought with a cushion. How do you determine intrinsic value? Graham provides various methods, looking at earnings, book value, dividend yield, and comparison to similar companies. The exact method matters less than the discipline of only buying when the price is significantly below your estimate of value. Remember, the margin of safety isn't about being pessimistic or missing opportunities. It's about being realistic and protecting your capital. In Graham's words, the margin of safety is always dependent on the price paid. Buy carefully, and you will sleep better at night. Part 5. Defensive versus enterprising investors. One of Graham's most practical insights is that there's no single right way to invest. People have different temperaments, available time, and risk tolerances. Instead of forcing everyone into the same strategy, Graham identifies two distinct approaches: defensive and enterprising investing. The defensive investor is someone who wants reasonable returns, without losing sleep over their investments. They prefer safety over spectacular gains and simplicity over complexity. Most importantly, they don't want to spend significant time researching investments. Graham's strategy for defensive investors is beautifully simple: maintain a diversified portfolio split between high-quality bonds and high-quality stocks. His suggested allocation is 50% stocks and 50% bonds, with the ability to adjust this ratio based on market conditions, perhaps as conservative as 25% stocks, 75% bonds, or as aggressive as 75% stocks, 25% bonds. For the stock portion, defensive investors should focus on large, established companies with strong financial positions, stable earnings over at least 10 years, regular dividend payments, reasonable valuations. Think companies like Johnson & Johnson, Procter & Gamble, or Microsoft. Boring, perhaps, but profitable and stable. The enterprising investor is willing to devote significant time and effort to research in hopes of achieving superior returns. They understand that higher returns require higher risk and more work. They're not necessarily smarter than defensive investors, but they have different temperaments and priorities. Enterprising investors can explore undervalued individual stocks requiring detailed analysis, special situations like corporate spin-offs or mergers, smaller companies with growth potential, more complex financial instruments. The key distinction isn't about intelligence or wealth, it's about temperament and time commitment. Graham emphasizes that both approaches can be successful, but mixing them often leads to disaster. The biggest mistake investors make is thinking they're enterprising when they're actually defensive in temperament. They want the higher returns of active investing, but aren't willing to do the necessary work. They end up buying hot stocks based on tips or trends rather than thorough analysis. Consider this example: a defensive investor buys a broad market index fund and holds it for 20 years, earning the market return with minimal effort. An enterprising investor spends hours analyzing individual companies, builds a concentrated portfolio of undervalued stocks, and potentially earns higher returns through skill and effort. Both strategies can work. The defensive investor might earn 8 to 10% annually with minimal stress. The enterprising investor might earn 12 to 15% annually but with significant time investment and higher risk. The tragedy is the pseudo-enterprising investor, who thinks they can get enterprising returns with defensive effort. They buy individual stocks without research, chase performance, and switch strategies frequently. They often end up with returns worse than either pure approach. Graham's advice is clear: honestly assess your temperament and time availability, then choose your approach and stick with it. If you want simplicity and peace of mind, be defensive. If you're willing to work hard and accept higher risk, be enterprising. But don't try to be both. Modern investors have even better tools than Graham's original readers. Defensive investors can use low-cost index funds to achieve instant diversification. Enterprising investors have access to more information and analytical tools than ever before. The choice is yours, but make it consciously and commit to it fully. Part 6: Investment Strategies and Principles. Now that we understand the investor types, let's explore the specific strategies Graham recommends for building wealth over time. These aren't get-rich-quick schemes, they're time-tested methods for steady wealth accumulation. Dollar-cost averaging. This is perhaps the most powerful strategy for ordinary investors. Instead of trying to time the market, you invest a fixed amount at regular intervals, monthly, quarterly, or annually, regardless of market conditions. Here's why this works. When prices are high, your fixed investment buys fewer shares. When prices are low, it buys more shares. Over time, this smooths out volatility and reduces the average cost of your investments. Consider investing $500 monthly in an S&P 500 index fund. Some months, when the market is up, you will buy fewer shares. Other months, when the market is down, you will buy more shares. After 20 years, you will have accumulated shares at an average price that's likely lower than if you tried to time your purchases. Focus on fundamentals, not hype. Graham emphasizes investing in companies with strong fundamentals, consistent earnings, solid balance sheets, and sustainable business models. This means ignoring the latest fads and focusing on businesses you understand. During the 1990s dot-com boom, fundamental analysis seemed old-fashioned. Companies with no profits were selling for billions. But Graham's disciples, who stuck to profitable companies with reasonable valuations, avoided the subsequent crash and continued building wealth. The power of dividends. Graham was a strong advocate for dividend-paying stocks. Dividends provide several benefits. They offer current income regardless of stock price movements. They force companies to maintain financial discipline. They historically provide a significant portion of total stock returns. They can be reinvested to compound your wealth. A company that pays a 3% dividend yield and grows that dividend by 5% annually can provide substantial wealth building over time, even if the stock price doesn't move. Avoid market timing. Graham consistently warns against trying to predict short-term market movements. Even professional investors rarely succeed at timing the market consistently. Instead, focus on time in the market rather than timing the market. The data supports this approach. Studies show that missing just the 10 best days in the market over a 20-year period can cut your returns in half. Since the best days often follow the worst days, timing strategies often backfire. Quality over quantity. Graham advocates for concentrated investing in quality companies rather than diversifying across hundreds of mediocre ones. For individual stock investors, 10 to 20 well-chosen stocks can provide adequate diversification while allowing you to focus on quality. Rebalancing. Periodically review and adjust your portfolio to maintain your target allocation. If stocks have performed well and now represent 80% of your portfolio, when you wanted 60%, sell some stocks and buy bonds to rebalance. Patience and consistency. The most important strategy is simply sticking with your plan. Markets will fluctuate, economic conditions will change, and there will always be new investment fads. The intelligent investor maintains discipline and stays focused on long-term goals. Graham's strategies aren't exciting, but they're effective. They have helped millions of investors build wealth over decades. The key is choosing strategies that match your temperament, and then having the discipline to stick with them through all market conditions. Part 7. How to analyze stocks for enterprising investors ready to pick individual stocks. Graham provides a framework for analysis that focuses on business fundamentals rather than market sentiment or technical indicators. Start with earnings history. Look for companies with stable, growing earnings over at least 5 to 10 years. Avoid companies with volatile or declining earnings, as these are harder to value and riskier to own. A company that earned $1 per share 5 years ago and now earns $1.50 per share shows steady growth. A company whose earnings jumped from 50 cents to $2 to 25 cents to $1.75 shows volatility that makes future predictions difficult. Examine the dividend record. A consistent dividend payment history indicates financial strength and management's confidence in the business. Look for companies that have maintained or increased dividends for at least 10 years. Remember, individual stock analysis requires significant time and effort. If you're not willing to thoroughly research each investment, stick to the defensive approach using diversified index funds. Part 8. Common pitfalls and investor mistakes. Even armed with Graham's principles, investors consistently make predictable mistakes that destroy wealth. Understanding these pitfalls is crucial for long-term success. Overtrading. The urge to constantly buy and sell is one of the biggest wealth destroyers. Every trade involves costs, commissions, taxes, and bid-ask spreads. More importantly, frequent trading is often driven by emotion rather than analysis, following the crowd when everyone is talking about the same investment. It's usually too late to profit. By the time a stock becomes front-page news, it's likely overpriced. The intelligent investor often does the opposite of what's popular, believing past performance guarantees future returns. The disclaimer: past performance doesn't guarantee future results isn't just legal protection, it's a fundamental truth. Last year's best performing stock or fund is often next year's worst performer. Overconfidence during bull markets. When markets are rising, investors tend to become overconfident. They forget about risk, leverage up, and make increasingly aggressive bets. This sets them up for disaster when markets inevitably turn, panic during bear markets. Conversely, when markets fall, investors often panic and sell at the worst possible time. They lock in losses and miss the recovery, ignoring fees and taxes. High fees and frequent trading can significantly erode returns. A 2% annual fee might seem small, but it can reduce your wealth by hundreds of thousands of dollars over a lifetime. Lack of diversification, putting all your money in one stock, sector, or asset class is a recipe for disaster. Even great companies can fail, and even great sectors can underperform. Trying to time the market, consistently predicting market movements is nearly impossible. Investors who try to time the market often miss the best days, and underperform simple buy and hold strategies. The solution to these pitfalls is discipline, patience, and sticking to proven principles. Graham's approach helps investors avoid these common mistakes by focusing on fundamentals rather than emotions. Conclusion: how to become an intelligent investor. We have covered a lot of ground, but becoming an intelligent investor ultimately comes down to a few key decisions, and the discipline to stick with them. First, define your investment style. Are you a defensive investor who wants reasonable returns with minimal effort, or an enterprising investor willing to work hard for potentially higher returns? Be honest about your temperament and time availability. There's no shame in choosing the defensive approach. It can still build substantial wealth over time. Second, focus on the fundamentals. Whether you're buying individual stocks or index funds, focus on intrinsic value rather than market sentiment. Ask yourself, what is this actually worth? Rather than, what will someone else pay for it tomorrow? Third, always maintain a margin of safety. Don't pay full price for anything. Buy when assets are trading below their intrinsic value. This protects you against errors, and provides opportunities for superior returns. Fourth, embrace volatility as opportunity. Instead of fearing market fluctuations, use them to your advantage. Remember Mr. Market, he's there to serve you, not guide you. Buy when he's pessimistic and sell when he's overly optimistic. Fifth, stay disciplined. The most important factor in investment success isn't intelligence or luck, it's the ability to stick with your plan even when it's uncomfortable. This means buying during market crashes, avoiding get-rich-quick schemes, and thinking in decades rather than days. Finally, accept that building wealth takes time. There are no shortcuts to financial independence. The magic of compound interest only works if you give it time to operate. Start early, invest consistently, and be patient. Graham's approach isn't about getting rich quick, it's about getting rich slowly and surely. It's about sleeping well at night while your wealth grows steadily over time. It's about having the financial freedom to live life on your terms. As Graham himself wrote, to achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks. The intelligent investor doesn't need to achieve superior results. Satisfactory results, compounded over time, are more than enough to build lasting wealth. The principles in The Intelligent Investor have guided successful investors for over 75 years. They will guide you too, if you have the wisdom to apply them and the discipline to stick with them. The market will always fluctuate, economic conditions will always change. But the principles of intelligent investing, buying with a margin of safety, focusing on intrinsic value, maintaining emotional discipline, and thinking long-term, these principles are timeless. You now have the knowledge. The question is, do you have the discipline to apply it? Your financial future depends on your answer.